Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. Monday, June 10th, 1 p.m. on the East Coast. Guy Adami, Dan Nathan sporting his risk reversal swag. Look at, move that mic for a second.
Yeah,
and
it's pretty dope, isn't it? It's pretty dope.
What?
It's pretty dope, as the kids say, Guy.
Do people really say that?
Yeah, I say it all the time. It's in our chat. You know what I mean? Amanda said nice digs, nice fit. That's what the kids say. They say nice fit. That means like
nice
outfit.
Fit.
Yeah.
Oh, in other words, not nice fit in terms of how it's fitting you, but nice fit as a sort of a shortened version of outfit, because people are too busy to use multi-syllabic words.
Yeah, exactly.
Yeah. By the way, before we get into the rundown, and we will, there were two big events this weekend. Well, there were, a lot of big events, but number one, the big event was on Saturday. Elizabeth Young got married, and we were there. It was lovely. We talked about it earlier on the Tape podcast with her, which is probably dropped already in your favorite podcast store. But you were there with your beautiful wife. I was there with my wife. Joe Terranova was there. Scott Wapner and his wife. Yes. Joe Marchese was there with his wife. Amorosa right?
Yep.
Anastasia.
Yeah.
It was fun.
It was great. It was a beautiful night. Liz looked amazing. She gave a little short speech in the beginning. She is like a good orator. I mean, let me tell you something. She was excellent. So she had a great time. Her family, her friends. It was amazing. Yeah, that was
one big event. Then now again, the NBA was a thing for me in the 90s when basketball game wasn't a video game, and when the Knicks were good, and the Knicks Pacers, Knicks Bulls, Knicks Heat. I mean, it was crazy basketball back then. Now it's, you cross half court and you launch shit up and you see if it goes in. It's not as interesting. However, it is the NBA Finals. And yesterday was game 2 in Boston, which Celtics emerged victorious, a game that was really never in doubt. But the big takeaway from that was you were like front and center the whole game.
Yeah.
Look at that.
Look at that. Okay, man.
Wait, now
what you did there.
I don't know who the dude with the sun. I'm sure I'm supposed to know who that guy with the sunglasses is. I'm sure he's somebody.
Yeah,
that's you.
Travis Scott. That's Travis Scott. I was sitting right behind him. Our good friends, Wick Grossbeck, and that's his lovely, lovely wife, Amelia Grossbeck. So Wick is the governor of the Celtics. He's been on the pod. He was on OK Computer. I'm going to get him back after they win a championship. Great dude. Stop. Yeah.
Now, if he's listening to this, which I hope that he is, I'm going to step in and say, Dan said that he does not speak on behalf of the entire risk reversal community. He's one of these people that thinks you just say stuff and it manifests. Like I am, don't touch the money person. So they've won nothing yet. They've won 2 games. They need to win 4. Yeah. And when they win the 4th, then we can have that conversation. But until then, don't put the horns on them. Anyway, please continue.
Here's my prediction, because I'm not a superstitious guy. I think they split in Dallas and they come back and win in game 5 on Monday. So that's my 2 cents.
Okay, there you go.
I'm rooting for the Grossbacks. Wick's story, and we're going to do it on let's do it on the tape, because I'd love for you to be involved in it. You'd find it pretty fascinating. He was a private equity guy, still has a fund. He put together an investor group 20 years ago, and what it took for him to do that personally and with this group, it's pretty fascinating. They won 1 championship. Hopefully they win another. How's that guy? All right.
Nice job.
We'll leave
and I don't know what Wick is short for, like, Ballywick or
Wycliffe. And he is an amazing musician, too. He has a band called the French Licks. I've seen them on a few occasions. He rocks the house. He used to be a drummer, and now he is a lead guitarist, and he does some vocals. So it's a lot of fun. Wick's a great person. So is Amelia, his lovely wife. All right. Okay. Should we do this thing, guys?
All right. Throw the rundown up, because, as much as it's a pretty benign day, as I like to say, there's always something going on beneath the surface. So we're going to check on market breadth, because I think it tells a bit of a different story. That's just me.
Yeah.
It's funny. I don't know what that cat's name is. If I get all the time, he is so I don't know what the word is, animated about these Apple events. Like I can't get over how excited he gets. And he tweeted something about, OMG, I'm at the Apple event. And I'm like, and I tweeted back at him, so exciting. Now, I'm sure there are people out there that would think that I'm actually excited by it, because sarcasm does not come through in the written word. But man, oh man.
Wait, guy, can I ask you a question? So they have
what gets me excited. Was that what you were going to say?
No, there's like 200 fonts, right? There's like probably more, right? Why isn't there a sarcasm font? It would be so easy to do a
Hmm.
universal sarcasm font. Let's do it, people.
Fair. You know what? Fair enough. But again, I guess the pushback there would be if you needed a font for it, then
No, but there's a lot of dense people out there, Guy. Hey,
yeah.
so we got the Worldwide Developers Conference. We're going to talk a little bit about Apple. And then software earnings. This is something you and I have been talking a lot about because there's very few companies that have put up the sort of results and guidance that have got them going higher. You just have to think back to Workday, Snowflake, which is making new 52-week lows today. So Adobe and Oracle this week are going to be kind of interesting, Guy.
Agreed. And listen, we've made that point a number of times. You've talked about it, and it appears as though not only are investing dollars not going into software, but going into AI, in basically investment dollars, or is what, and there's a difference, obviously. So speculators and market participants on one side, and then investment in terms of CapEx on the flip side, and they're both going to the same place. So we'll talk about that. But this is the next slide, the first slide, I should say, is something that Liz and I talked about, and I'd like to get your take on this because, again, below the surface, this is how we started. The S&P 500 is effectively at an all-time high. I think, that is just factually true. But beneath the surface, damage almost on a daily basis continues to be done. And sometimes it's done in the form of, 7, 8, 10% moves to the downside in one fell swoop. And, I don't know necessarily what it means. And I had this conversation with Liz. I think a lot of it has to do with passive investing. And you have these one-offs in terms of individual names, but the passive side is seemingly creates a lot of above the surface. The passive side creates a lot of what appears to be calm, and below the surface, anything but.
Yeah, I had a conversation today, just now, with Dan Niles of
The Annihilator,
the Niles Investment Group. And it's going to drop tomorrow on OK Computer. And we were talking about Apple, we were talking about Nvidia, we talked also about this kind of scenario where investors are fairly well convinced that if the Fed cuts rates because things are slowing, that's going to be good for the stock market. If the Fed doesn't do anything, the way equities have been moving on the index level, right, with yields higher for longer, that's also good because you can see a lot of things that have been benefiting other than the consumer's ability to keep up with inflation, right? But from a risk asset standpoint, we had the height of inflation in 2022. We also had that correspond with the low in the stock market, yet rates have not budged, right, since the end of 2022. They've stayed up at this kind of upper band of 5.5% as it relates to Fed funds, right? So to me, I find this setup really interesting, and I'm not going to say, I'm just going to say this, don't get too aggravated. A lot lot of folks think this
please
is
don't say it. Don't. They're not this early in the week.
okay.
Don't, please,
All right.
because
They
you're going to
think
say it's a
very good
Goldilocks, right?
scenario. Oh, right.
Yeah, I know.
Okay. So so Guy, the only thing I would push back on that whole notion is that you have a VIX just below 13, right? You have rates that quickly bounce back to basically 4.5% in the 10-year. And after tomorrow's CPI and the Fed's meeting on Wednesday, you might see inflation expectations stay put, and you might see rate cut expectations go away for 2024. And then the other thing I'll just say is that you said, under the surface, this reminds me a lot of late 2021 when the Fed said they are going to start this rate hiking cycle to combat inflation that is basically stickier than they thought it was going to be. Remember the whole transitory argument in 2021. And under the surface, there were lots of groups in the market, despite the S&P making a new all-time high in January of 2022, that were telling a very different story. And you brought this up. Look at the XLI. It never confirmed the high in the S&P 500. That's industrials, right? You can look at the IYT. That's transports, right? Look at how far the transports are from their recent 52-week highs. So that goes back to the whole Dow theory, kind of analysis. But yeah, if you do that on a shorter term basis, the BKX is traded okay, did make a new high, but it's come off, Guy. So there's lots of important sectors in the markets that have not confirmed the S&P 500. And I just want to make the last point, and I'll shut up here, people. It comes back down to the Fab Five, okay? Apple's rallied 20% since April. We know that Microsoft is kind of staying put. Google is very near its all-time highs. Meta got back there, and Amazon, So again, that speaks to, I think, where you want to go as far as breadth in the market here.
Oh, no, listen, no question about it. And I think CPI is Wednesday, not to nitpick, but your point is well taken. I mean,
Yeah.
you're going to have a data point into their commentary. So we'll see how it plays itself out. Again, the volatility, seemingly volatility back in rates. It's interesting, depending how you look at things. Carter would say it's a lack of volatility in rates. We effectively haven't moved over the course of a year and a half. And I would say the flip side, these 15, 12 basis points moves up and down are anything but normal, but they've gotten us right back to where we started. It's just sort of, I guess, how you get there. With that said, Doug Cass is not an investor in risk reversal. He's not a paid contributor of risk reversal. However, he contributes mightily almost on a daily basis. And he sent us something earlier today, and we always like to cite him when he helps us, which he does, as I mentioned, almost on a daily basis. But let's put up this chart because this is something that he has brought forth and we've talked about. The relative strength. So equal weight basically versus the broader market. And this is an equal weight tells a much different story. And when you look at it here, as opposed to the S&P, which, as I just said, making an all-time high, again, this is just another way to look at that, those handful to a dozen names which have been carrying the load. And when you look at it in terms of equal weight, obviously it tells a much different story.
Yeah, and we had this segment last week on Fast Money Guy. It might have been on Tuesday or Thursday. We opened the show with the most important chart in the market. We all went around with that, and this was mine. And again, I know that Doug's been talking about it, but it's something that you and I pay close attention to because, again, it just speaks to the fact that you have 3 stocks that make up 30% of the S&P 500, 5 that make up, a little more than that or whatever. And maybe I have my numbers off. Oh, the three biggest, NVIDIA, Microsoft, and Apple, I think make up 20%. The Fab 5 makes up 30. And so Carter's done some work on that historically, kind of what that concentration has meant. We've always had concentrations, but this is important. When you see it relative performance-wise to the equal weight, it's kind of showing, it's telling a different story. So again, we can look at all the sectors. We can look at what is kind of catapulting some of those huge names. And I'd throw Eli Lilly in there too, because that's become an awfully big name. It seemingly makes new highs every day. That's one of these mega trends. And it seems to be something that investors, there's no high enough to keep paying for these things, Guy.
Well, and only because, again, with passive investing, and other factors at work, you throw everything else out the window. It's just, where can I get my investment dollars? Where am I going to get the return? And when seemingly no news is consequential enough to stop that, you're going to continue to see this. But this to me is, I don't know, I don't want to use the word concerning. Maybe that's a little too dramatic, but I do think it's concerning. Other people will say, well, the fact that the S&P has been able to do what it's been able to do, once you get catch up, once you get some basically participation from these other names, we're going to be off to the races. We'll see. But, the next tweet from CQ and the adjacent charts suggests that maybe not so fast. And, this is something that Carl puts out. Carl puts on his Twitter account. He cites a lot of the different strategists and the different economists out there. Well, he's citing this. And, again, I think what this is pointing out is, you need confirmation, and you need confirmation from a number of different things, and you're certainly not getting it in the form of the advanced decline line.
Yeah, so let's look at this. It's from Bank of America. The SPX achieved a new all-time high last week, but the advanced decline line, 5-day put call ratio, the U.S. high yield OAS, the corporate BAA spread, and the new 52-week highs did not confirm the new highs in the SPX. These negative divergences are tactical risk for the U.S. equities in June. SPX supports are 5191 and the 5,000 to 4953 range. So that's from Bank America. So negative divergences, that's also what we were talking about with some of those sectors. There's a bunch of Wall Street mumbo jumbo in there with some acronyms, Guy. You know what an acronym is? We do that on CNBC.
Yeah, a bunch of letters, you put them together and you try to be clever.
It means something here. So again, it's worth pointing out, this is not something that's particularly tradable, but it comes back, in my opinion, to low volatility readings. And then the other thing is, Guy, we're June 10th. And as you say, the month is going like that, right? So pretty soon we're going to be at the end of the quarter, and then we're going to be really focused on earnings, especially when we have the Fed meeting out of the way and some of the inflation reading. And, let's see what yields do on a relative to the data and that sort of thing. But, earnings are going to be really important because just like last year, 2023, there was a lot of excitement in the first half of the year, and we knew very little about what the market opportunity was going to be for generative AI. We knew that ChatGPT was out there. It was ripping. We knew that Microsoft made a huge investment in that. We knew that Google's launches were not particularly great, relative to what we saw out of OpenAI. But we still had this period, and really, I think it started in the second week of earnings in late July, Guy, where we saw a meaningful sell-off, to the October lows, and it felt like something that had the potential to catch some steam, but then we saw guidance that wasn't as bad as expected. And so one of the points I just want to make is that Microsoft, Google, Amazon, Apple's in the same spot it was at that point. But, these stocks and NVIDIA, has gained like $2 trillion in market cap, since then. So I would make the argument that expectations are super high headed into Q2 earnings. And if we don't get Q3 guidance or back half of the year guidance that you can extrapolate, I think you're going to have another sell-off. And again, if you're in the camp that you think that, generative AI is going to be transformative, not just right now in a handful of names that are either selling the chips or, Microsoft is integrated into their, suite of products, and Google's going to be able to do this thing, but across other industries, right? Well, if that's your longer term view or intermediate term view, a sell-off might be something that is pretty palatable, you know what I mean? Especially with an S&P, and we quote Butters all the time, that is trading, at 21 times, fairly rich, or maybe more than 21 times to its 10 and 5-year averages.
No, and we're going to quote Butters again in a second, but to your point, I think that's exactly right. And I don't want to get bogged down in the AI thing, but it's still, I understand total addressable market. Like I understand all the bull cases for it, but I'm also waiting for somebody to explain to me the monetization ability for a lot of these companies in terms of what AI is going to do for them. Some have tried to talk about it and some have tried to explain it, but quite frankly, the spend doesn't seem to be any correlation in terms of the offsetting revenue, stream that this is going to create. Now, people will say, well, you're missing the point. Productivity is going to go through the roof. And yeah, maybe that's true. But again, there's a lot of hopium in this as well. There's a lot of factual data that supports it without question. I mean, the spend is real. You can't take that away. But, a lot of the spend, and you've talked about this, the potential for double and triple ordering, right? And the potential, obviously, for there to be, in my opinion, huge competition to come down and knock those robust margins down to levels that historically the space trades at.
Yeah,
we'll see. In terms of Butters, we
well,
like
hold
to
on.
quote
Can I
Butters.
just make,
Yeah,
can I
of
make
course, your
here?
podcast.
So, one of the things that's really interesting about the ordering, okay, is that, we had this story last week that Elon Musk diverted a bunch of these H100, these NVIDIA, high-end GPUs, to XAI, which is his AI company that just raised $6 billion, and to Twitter. And so to your point, you put these orders in 6 months, a year ahead of time. There are such shortages on these things that who knows where your business is going to be and your ability to digest these or build on top of them or build the servers and build out the data centers and all that sort of stuff. So, part of that is that, they just didn't have the use for them right now. And if you have a glut after these folks have bought them and they have to basically dump them, okay, so like on the gray market or whatever, they're going to take some losses on this sort of stuff, some write-downs. And we already saw the companies that were being penalized for greater than expected spend. Meta was one of them when they reported Q1, right, results. So this could be a pretty funky situation. And then if you have some gluts at certain customers and China is not able to buy these things, you know what I mean? You can have yourself in a situation where NVIDIA actually has to guide down. Let's have them throw up an NVIDIA chart before we get to Butters. I think we have one, Guy. This stock, if it were to go back to the April lows, okay, just the lows that it, and the throes of that sell-off, which was down 20%, 20 or so percent from its March highs, you're talking about a 40% drawdown. It would be 50% cut in half to just the 200-day moving average. And I know that sounds crazy to some of you people, but when they report in late August or a bunch of their customers report in late July, and it shows deceleration in CapEx and the like. And remember that Meta, Amazon, Google, and Microsoft make up 40% of their revenue. So there's that concentration there. So to me, I think the idea that the stock could sell off 30% back to its breakout level, or 40% back to the April lows, or 50% back to its 200-day moving average, most of you guys are out there thinking I'm crazy. But come on, man, like that could be in the cards later this summer.
Nobody's talking about that, and I do think there's more than a reasonable chance of something like that happening. By the way, we've seen it before, and this is a static NVIDIA chart. If Jacob and or Amanda can put up a longer term chart, and you see just in this chart some of the unfilled gaps to the downside.
Yeah.
I mean, go back and look at a huge unfilled. That's too long, I think. If we could just do a shorter term chart, you'll see this basically unfilled. There it is, right there. And then you go back to April of 2023 ish, and you see that. Remember, we had that huge gap up at the time. I think it was from like 280 to 320 or something, and then it was all. We've never seen it again. So that's out there as well. And I'm not suggesting we go there, but this is just a series of unfilled gaps. Now, I incorrectly said we have something from Butters. Butters to me has become sort of ubiquitous with a lot of things, but this is just FactSet data. So I apologize for the error, although Butters is omnipresent, as you know. But let's take a look at this, because I do think this is interesting. This speaks to what we teased earlier, market breadth. And again, I don't know necessarily everybody's going to look at this and take away something different, but these are interesting numbers in the face of, again, a broader market that's at an all-time high.
Right. And so if you think about this, so 8% of the stocks are within 2% of their 52-week highs, but we know that a good chunk of those names are those heavily weighted names, right? In the market cap weighted S&P 500, 30% of S&P stocks are within 5% of the 52-week high, 48% are within 10% of the 52-week high, and 52% of S&P stocks are 10% or more off of the 52-week high. Now, listen, depending upon your lens, half empty, half full, you know what I mean? As far as the markets, you could probably make an argument for either way, right? Like of these sorts of things. So again, it really comes down to what is the back half of the year, or at least Q3 guidance? Does it support S&P valuations that are pricing in 11, 12% earnings growth? And, you and I have been kind of on the other side of that. I think late last year, we thought the chances of double-digit earnings growth for the S&P 500 was not particularly likely. The more we get into this year, right, and we don't see estimates come down particularly high, and we'll get some Butters data, because I think towards quarter end, Guy, he's going to start updating some of those, estimates of where the street consensus moves, how much is cut into the end of the quarter, and then how much of the beat rate. I think that's always good data. But again, you know what I mean? I think it's important to really continue to focus on breadth, market breadth.
No, and it's something that people talk about. You can't trade necessarily on the back of it, but to sort of discount it or dismiss it, I think is foolish, because again, sometimes this is an early indicator of exhaustion and potential, again, bottoming formations, or in this case, potential topping formations. Let's take a look at GM real quick. And this is our static chart, and we'll take a look. It's breaking out. I mean, we're at multi-year highs here, and probably for good reason. GM seemingly starting to figure things out, but I don't want to get bogged down here. If we go back and look, I mean, this is a multi-year high, but if you go back to the duration of this new iteration of GM, I mean, we're outside of this huge run-up we saw in 2021. I mean, this stock is back to levels that we basically saw 7 or 8 years ago. So it's interesting in terms of today. It's not particularly interesting, though, in terms of the life cycle of this company.
Yeah, what I think it says, Guy, is that the about face that they've done on their EV push over the last year, and then their greater push into hybrids, right? So I think that's something that's really interesting. And then if they just want to pull up the Tesla chart for a second, so this is up 78%, let's say, in the last year.
Yes.
Okay. And again, it's still a $54 billion market cap. We know that they have also a ton of debt. Let's back that out, a little. Well, I mean, again, this is, upper left, bottom right, over the last year. So it really, again, this is still a $500 billion market cap company, and GM is, on a market cap basis, 10% of it. But my only point here is it speaks to at least what investors are thinking about as far as EVs versus hybrid EVs, right? And so, on the call, in Q4 call, or actually it was the Q1 call just I think about a month ago. Elon was basically saying that he does not believe that hybrids are going to be the way forward, and they're not going to create one. And so again, he might be right, but in the near term, investors are rewarding GM, rewarding Ford, rewarding some of these other automakers around the world, and they're penalizing, Tesla for is in what is going to be like overcapacity as far as their build out of these gigafactories. You know what I mean? They're the price war that they're in, the way the direction the margins have gone, and then the competition with Chinese EVs. And it's interesting. And Dan Niles and I had this conversation, and I'll just leave it here. But Elon has flip-flopped since late January about trade barriers on Chinese EVs. He said back then on his call that they are going to demolish, automakers around the world with cheap EVs unless there are trade barriers put up. And then a few weeks ago, he just turned on that, which is kind of interesting. So now he's saying that he doesn't support tariffs. And I wonder if that has something to do with his very cozy relationship with this finance minister, whoever this vice premier is, that he went over and saw and got some sort of approval for full self-driving in China. Do you remember that? And that's
I do. And I don't think there was any formal approval, although, the market reacted as if there was. And, quickly last week on Fast Money, we had sort of the tale of two Teslas. I think one analyst, I want to say, had a $200 objective for this year, and another one had a $125 one. And Mel came to me and I said, it's funny with this stock, they both might wind up being right. And you could see, we've seen it before, these knee-jerk reactions to the upside on whatever piece of news, but the trajectory, to your point, has been upper left, lower right. So there is a chance that both those situations might happen. My chart of the week, or excuse me, my most important chart on Fast Money last week was the KRE. So let's take a look at this, because again, not trading particularly well. That's a static chart. You can pull up a longer term chart and you'll see, we obviously bounced pretty significantly from those lows we made in the Silicon Valley Bank days that May of last year, and for good reason. With that said, nowhere near the prior highs, and an index in this case that has not been, or an ETF that has not been trading well at all. And I think this speaks to, again, I'm convinced the unemployment rate is going to tick up in a meaningful way. I've thought that for a while incorrectly, but I think maybe we saw glimpses of it last week, and I don't think that's supportive. And again, with what's going on with small and regional banks in terms of some of the exposures they have, I don't think this augurs particularly well for the broader economy. Maybe not necessarily the stock market, although I do think it will, but for the economy in general.
Yeah, the stock market really hasn't cared much about
Not at all.
About this exposure that regional banks have to commercial real estate, despite the fact that we get a lot of negative headlines, it seems like every day, about commercial real estate. And I'll just say this kind of $46 level guy in the KRE that they drew a nice little support line there. We just broke the 200-day moving average. So from a technical basis, I think that, is kind of interesting. So again, we don't want to dwell too much on that, but you put that together with the BKX that sold off, at least a few percent over the last, week or two. I think that's kind of interesting. And again, you should have your antennas up about that a little bit. Let's talk about Apple, Guy. This 20% rally that I just mentioned. So right now, as we're going on, and we're, the Worldwide Developers Conference is going on in Cupertino. That's Apple's headquarters out there. Expectations, I'd say, are high because of the 20% rally the stock has had. You see that gap above its 200-day moving average, and that had to do with that $110 billion buyback. But this is a company that's been buying back basically $20 billion of stock each quarter, or maybe, I can't remember what the buyback was, but it was huge. And you had that big gap, and it's been a runaway since then. But we draw that resistance line because on 2 times over the last, call it, I don't know, year or so, this stock has not been able to, break out above $200. And I'm just not sure what they're going to have to say. Even with Sam Altman, the CEO of OpenAI, if he shows up on stage with Tim Cook, I just don't think these products, their inability to kind of integrate it into iPhones that are going to basically ship in late September, early October. I just don't see a big upgrade cycle on anything other than maybe what excitement around software, or how they're able to kind of in the next few months. And I just don't see it, Guy, how they're able to make Siri this ever-present thing on your hardware device, that you buy from Apple. So thoughts on that? Because for establishing a new range above $200, you have to basically get very confident that their earnings are going to continue, well, actually are going to grow again, right? And the revenue, which has been flat over the last few years, is going to be able to grow again. And the street, for some reason, has consensus gross margins moving from 44.5% this year, Guy, to about 46 and change next. And I don't know where that comes from, because this is a company that's going to have to really dial up the spend to get up to speed with some of their competitors on generative AI. I don't mean that they have to spend to create a large language model, because that's what they sounds like they're going to license from OpenAI, but something's going to have to give here that is not consistent with the level of innovation that they've had over the last few years.
Yeah, I mean, if the spend does happen, I'm sort of with you on the margin front, because margins have been basically flatlining to deteriorating for the last few years. So I don't know where the reaccelerations margins going to come from, but we'll see. But again, not to belabor things, but Apple wins to the passive investing world. I think in 314 ETFs or so, Apple's one of the top 15 holdings. So as money flows in, Apple wins regardless. And what I found interesting, Liz and I talked about this earlier this morning, was if you had told me earlier in the year, at the beginning of the year, that Apple would draw down from 195 down to 165 and then say, okay, on the back of that, what's the S&P? And I would have thought mid 4,000s. And obviously the S&P was able to rally in the face of that. So I guess the market doesn't need Apple as much as I thought. And now here we are with Apple basically back to an all-time high. But it has not gotten cheaper. It's gotten more expensive. So it's all just multiple expansion, continued multiple expansion, one, and continued, I guess, hope of this AI integration, which, is going to happen at some point. But, you'd use the word iterative all the time. One has to wonder how it's going to move the needle, but we'll see.
Yeah. One thing that just broke here, Guy, on the information, I think this is interesting. I don't think it's market impactful, but so OpenAI, they had all this excitement late last year. Sam Altman out, the board kind of ousted him. Microsoft came in to defend him. He came back, and then they basically ousted, some of the senior leadership that kind of was involved in the coup. These two hires are really interesting, Guy. We met Sarah Fryer, I want to say 5 or 6 years ago, when she was the CFO of Square, and we met her with Jack Dorsey. Remember that? We had that kind of off the record meeting with them. And she's super impressive. And she was hired to be the CEO of Nextdoor, which went public via SPAC. And I always thought, man, she should have been on a short list to be the next, CEO of a publicly traded company. I thought Nextdoor was a bit of waste of her talents. And then Kevin Weil, who came on the pod OK Computer with me, I want to say a year and a half ago. Brilliant guy. He was like a product guy at Instagram, and then he was, under Meta, and then he was last president of this company called Planet Labs, which basically was using, SpaceX to, send up these. They were making this kind of satellite, and made these satellites which were like the size of a shoebox, and there was like this mesh satellite system. He's a genius guy, and I met him. I had dinner with him a couple years ago. So they're kind of beefing up the ranks a little bit, and that makes some sense if it's true that they're inking this big deal with Apple. I just thought that was interesting to kind of mention, because again, this was last valued at 85 billion, and I have to think at some point in the next year and a half or so, this is going to be a company that goes public.
Fair. And I'm glad you brought that up, because it is interesting. And then, what's also interesting, and we tease this, is the inability for software stocks to do well. And we have it through the lens of the IGV. And look, I think between Microsoft, Salesforce, and Oracle, I think you're talking about, a quarter of that ETF for those three names, probably about 8.5% each or so. You want to throw Intuit and Adobe in, then you're probably up to, 40%. With that said, has not traded particularly well. And again, maybe this is maybe we're making too big a deal out of this, but software was de rigueur for a long time. It was all the rage, and that bloom is clearly off the rose.
Yeah, no doubt. So this little slide that Amanda put together, I think is kind of interesting, because Adobe and Oracle report this week. And these are like two really heavily weighted behind Microsoft stocks in the IGV ETF. The Oracle move, 6.5% implied in either direction. And then Adobe, 7% implied move in either direction. And I guess the one that would concern me more, Guy, after the Salesforce results, after the Workday results, after the Snowflake results, would be Adobe here. And again, if this company, which has seemingly made pretty decent investments in generative AI in 2023, they were talking about a whole suite of services, you know what I mean, that they're going to roll out under the Firefly sort of name. So if this company guides down, I suspect you see this IGV back below its 200-day moving average. You see that gap that it tried to fill. That was on the Salesforce results last week. That stock was down 20% the day after its earnings. Oracle's a different one, and Dan Niles brought this up, and I think it's a really good point. And just by the way, I've mentioned that interview a lot. There's so much more than a few tidbits that I've just mentioned. So tomorrow morning when that drops, please go listen to this. But Oracle has quietly become like number 4 as far as like public cloud guy and the hyperscaler like component of this. So it's obviously AWS, and it's Microsoft, Azure, and then Google Cloud, and then Oracle. But the point that Dan made is that TikTok was a huge part of Oracle's cloud business, and if that were to decelerate, because there's been some kind of data of late suggesting that TikTok growth is moderating, especially here in the US. And if this company got banned here in the US, that would be a big hit to Oracle. So keep an eye on the sort of guidance that they have here.
I think software, again, it's passed the baton to AI, but it's no less important in terms of, I think, some of the stories they tell without question. We teased earlier, that's a pretty, what do they call it? What'd you say? Dope? You use that term,
Yeah,
right?
dope. Dope.
Again, I'm sorry. There's certain things that typically you'll never hear me say. That's probably one of them, but it is a pretty cool sweatshirt. But 2 weeks ago now, I think this is the 3rd week we've been doing this, at 4:00, right after the close, we drop our AI Brunson, and we call it Market Matrix. So
Yeah.
take a
AI
look at that.
generated, not generative AI. And it's really
Mhm.
important. People ask us how we're doing this. You and I and our team, we're curating what we think are the most important stories in the market for that day, in the economy. Maybe there's a little politics, because as we get further into, this season, we're going to have lots of debate over economic policy. So we put it into Perplexity. We get a summary. We cite everything. All of the articles that Brunson is summarizing are in the show notes there. So everything's properly attributed. And then we put it into this voice bot, and that's how you get Brunson. So again, go to the podcast stores, follow it, rate, review it. And if you do that, we're going to throw out, we're going to send you, okay, if you go to contact at riskreversal.com, send a screenshot of that review. Amanda's going to send you this tricked out t-shirt. Look at this, the Market Matrix t-shirt, and that's Market MRKT Matrix. So you guys know what to do. Get a tricked out t-shirt. Maybe they can throw the slide up, because that is the actual t-shirt that we have. Maybe they don't have the slide, but
No, they have it. They're hanging us out to dry, which they often do. And the old slide said leave a 5-star review. Then Amanda went on vacation. Then it just said leave a review. And then it's back to a 5-star review. Hold on, Amanda's texting me now. Give me a second.
she said she took it out.
I took it out because okay, there you go.
Yeah, she doesn't want to be part of that.
It's all right, but we'll have it for tomorrow.
Contact at riskreversal.
There, hold on. There it is.
Yeah,
I knew we had it somewhere.
So I'm wearing the sweatshirt, but if you want to wear the t-shirt, you could just leave a review. Go do that. All right, Guy, we covered a lot of ground. I just want to finish off by saying one thing. You started off, after we got through some of the housekeeping with Liz and my Celtics game yesterday, that we just have these days where I'm looking up in the S&P. You know what I mean? And the NASDAQ, they're just unchanged, right? And, again, we had 10-year yield either side of 4.5 over the last few weeks or so. And it really feels like something's going to come. Maybe there's just a runaway breakout in the S&P and the NASDAQ, or maybe there's a sort of downdraft that we had late last summer. But again, I think a lot of investors, if we were to have a pullback, would see it as an opportunity. And I don't know if that's the case. You and I, we thought the market would sell off in the spring. We were not quick enough to say, hey, listen, it's a buy here, because again, we have not had a 10% sell-off peak to trough in the S&P in a very long time. And we haven't had a down 2% move in the S&P in over a year. And I just feel like a little fear put back in this market would be kind of a healthy thing, Guy.
Well, I agreed. And before we get out, I mean, on a benign market day, you are talking about a VIX that's elevated. Well, elevated in terms of where it closed on Friday. I don't want to say it's elevated in terms of where it's been historically. So we'll see. I mean, there are a lot of interesting things, and obviously, I think market is positioning itself. We're waiting for CPI on Wednesday and the subsequent commentary from these geniuses at the Federal Reserve. With that said, that does it for today's market call. I want to thank everybody for joining. The Yankees do play tonight. They're in Kansas City. The Mets back from their London trip, gaining a split with the Phillies. Riding high, you Met fans. But you know what? You probably are high because they suck. And you got hockey tonight, Dan.
Yeah, you do. Game 2, Florida, Edmonton. Edmonton got the floor wiped by Florida. I guess at this point, you're probably pretty happy to see Florida.
No, I mean, I get it. I mean, again, Florida's just, they were a better team. They just beat the Rangers. I don't know what to say. I mean, a better team won. And outside of the Yankees, and Doug Cass, if you're still listening, outside of the Yankees, Pittsburgh Pirates World Series, I think it was 1960, which the Yankees absolutely dominated in the 3 games they won, like ridiculously so, but still managed to lose a 7-game series. The best team typically wins in a 7-game format.
Matter of fact. All right, Guy Adami, this was a lot of fun. You and I are going to be on CNBC's Fast Money at 5 o'clock. People check that out. We always have a lot of fun. Don't we have a lot of fun?
I have a ball. I mean,
yeah.
We've got to have fun. I mean, what's the point?
Well,
that risk reversal, that's a dope sweatshirt.
Well, you have one, Guy. You got to wear it, okay?
I don't. You know me.
You're not going to wear it? Seriously?
I'll wear it.
All right.
I'm not a swag, but listen, I'll represent.
You're gonna wear swag. Wear our swag,
right?
Okay?
I agreed.
By the way, like we created this brand. You know what I mean? Like we brought it.
I think it's great.
Okay.
All right. I mean, I'm a 60-year-old. I mean, people don't want to see me wearing shit. I mean, they have no interest in that.
I see you at home. You're often wearing sweatshirts. It usually has a Yankee thing on it or something like that. But I mean, you could wear a risk reversal. All right. People, just tweet at Guy or send him an email at contact@risk reversal and tell him to wear the swag.
Right on.
Wear the dope swag. All right, peeps. Thanks, everyone. Appreciate it.
Later.